Morning, everyone. So I'll quickly take you through our key staples. So we've had a quick review of the key quality counters that we have in our staples profile. And I think in light of the rising costs that we've seen last year and this year, we thought we should actually just look at our key counters. So just starting off with the portfolio positioning. So we are neutral, or we have a hold on Philip Morris as per the last report. And on Diageo, we're still maintaining our buy as per the last report, but we have changed now our positioning on Nestlé from a hold to a sell. I'll speak more on this as we carry on. So starting off with our executive summary, as I've said, we see all these counters as quality stocks, but given the rising costs, we've had to have a deep dive at them and rank them in terms of our preferences. So starting off with Philip Morris, we see the stock as a good counter, given the cash generation that we've seen in the past. I think the main moat for this counter is them having had a first move advantage in terms of the next generation products. And these are products that actually have higher margins compared to the traditional cigarettes. However, there are regulatory risks that are embedded in the sector, especially for the next generation products or your risk-reduced products, especially or they are more pronounced in the US as well as the Europe. So those still remain as a sector overhang. And in terms of where we see the company progressing, it's expecting to have around 50% split between its next generation products as well as the traditional cigarettes by 2025. So given the pending acquisition of Swedish Match, we think this will actually fast track it in terms of reaching that goal. However, last week we saw an update from Swedish Match where now they want to double the initial offer price. So that might actually not materialize this year in terms of them closing out this deal. So on that basis, the valuation is weighted more towards the organic company, that is Philip Morris, excluding the Swedish Match. And then moving on to Diageo, we continue to see this as a solid company. Its main catalyst of growth going forward, it's centered around the spirits business, where they've had also recent acquisitions. You will see when we look at the value creation spread that it's moved up and down because they've had a lot of acquisitions recently where they're trying to broaden their product offering. But yeah, so we continue to see it as a good quality stock. However, we have trimmed our intrinsic value to factor in the rising input costs. And then on Nestlé, again, it's a good quality business with diverse brands that span a broad spectrum in terms of the LSM. However, we have concerns surrounding the rising input costs. And this is mostly because if you look at the input costs and the composition, it's the one that's mostly at risk compared to the other two countries. Now, in terms of our valuations, so for Philip Morris, as I've said, we haven't changed our intrinsic since the last report. So I don't think I need to speak more on this. Our upside is at around 10%. The concerns, again, are around the Russia and Ukraine tensions. So just to give you a sense, those will actually result in the company having a decline in revenue of around 1% and an EBITDA decline of around 4.5%. This is if they don't close the deal with Swedish Match this year. And then moving on to Diageo. So initially we had our intrinsic at around £45. We have now lowered it to around £43, which gives us an upside of around 16.1%. And then on Nestlé, we lowered our intrinsic from 129 Swiss franc to around 121, which gives us an upside of around 7%.
Thank you very much for joining us today.